Good day, and welcome to the DoubleLine Total Return Webcast. Today's conference is being recorded. At this time, I would like to turn the conference over to the president of DoubleLine, Ron Riddell. Please go ahead.
Well, thank you, and good afternoon, and welcome to the DoubleLine Webcast with Jeffrey Gundlach and Andrew Sue. The title of today's webcast, Dust in the Crevices. A few housekeeping items, so I want to update you on some upcoming webcasts. Please mark your calendar for June 13th. We have our ETF webcast. As many are aware, we launched our ETF complex over a year ago. And just this end of this March, we actually launched two additional ETFs, the DoubleLine Mortgage ETF, DMBS, the ticker, and the DoubleLine Commercial Real Estate ETF, DCMB. And so we'll have Ken Shinoda and Morris Chen up on June 13th to discuss those two new ETFs. Then up on July 11th, we have our infrastructure webcast, the DoubleLine Infrastructure Income Fund. Our very own Andrew Sue, who's on the call today, will be up with Damian Contes to discuss that particular strategy. If you'd like to see the rest of the webcast schedule for 2023, please go to doubleline.com. And if you want to receive a copy of today's presentation slides, you can go to the Request Webcast Content tab here today. You can follow us on our Twitter handle, DLine Funds, and our YouTube page, DoubleLine Funds. I want to highlight some thought leadership in the media. We have two podcasts, the Sherman Show podcast and Monday Morning Minutes. And we also have a YouTube channel, Ken Shinoda on DoubleLine's Channel 11. And then we have the new PS Perspectives, our product specialist team does a series of videos highlighting financial markets, macro events, and drivers of returns in various segments of the market. So you can there's various mediums to view all of these or listen to these, but please just go to doubleline.com to find out the details. Want to highlight today we will be discussing the DoubleLine Total Return Bond Fund. Here you can see the different expense ratios and minimums along with their tickers by share class. And lastly, just standardized performance on the Total Return Bond Fund. The DoubleLine Total Return Bond Fund was launched April 6th of 2010. And through May 31st of this year, the annualized return is 3.81% versus the Bloomberg U.S. Ag Bond Index at 2.29%. So an annualized outperformance of 1.52% per year. And then you could also see the SEC 30-day yield, the net number for the institutional share class, 5.32%. So with that, without further delay, I'm going to turn the webcast over to Mr. Jeffrey Gundlach.
Thank you, Ron, and thanks everybody for joining us here as we barrel along through the middle of 2023. This webcast is entitled Dust in the Crevices. I'm having a hard time getting the slide. There we go. Just bear with me here. And as always, there's sort of layers of meaning to these titles. I'm having a hard time getting this slide to center on my screen. Try one more time. Okay, and basically where this came from was, for starters, I was looking at a sculpture, like a 110-year-old sculpture, and I asked the auction house for a condition report. And the condition report came and it said almost nothing. It said there is dust in the crevices of the sculpture, which I guess you'd expect for a 110-year-old sculpture. But it struck me that there's sort of dust in the crevices of our financial institutions here in the United States, and perhaps the general global world order. And it came into focus when I was coming up with a title for this webcast because the debt ceiling debate was going on. And going way back to basically when that sculpture was created, we've had the debt ceiling from basically about 1913 or so. And it's been raised now, I guess, 99 times. If the last one counts as a raise. I guess we just kind of eliminated it for a couple of years so we could spend as much as we want. But it seems to me that this debt ceiling thing is pretty dusty, and our method of getting along has gotten very, very dusty. On the title page of this presentation deck, I had the Grand Canyon, which is that's a pretty big crevice, but obviously it also serves as a metaphor for the huge divide of our political system. But here's the chart of the U.S. budget deficit as a percentage of GDP on a rolling, basically a one-year basis. And we see that we've been in a trend, and I've talked about this many times, we've been in a trend towards worse and worse budget deficits as a percentage of GDP. And we see that the extreme case, of course, was the COVID situation. We rebounded up to a budget balance as a percent of GDP that looks like the depths of past recessions prior to the global financial crisis. And now we have abandoned fiscal rectitude once again. And here we are in an economy that is supposedly growing, and yet we have 7.3% budget deficit as a percentage of GDP. We can see that it's climbing very quickly. And I would guess that with the bill that was just passed, that we're not going to see much movement in the positive direction of trying to balance our budget. And so we'll probably be headed towards a much bigger deficit as a percent of GDP, particularly if we go into recession. The red shaded bars on this chart are recessionary periods as declared by the economic group in the federal government. And we're already at levels that should be pretty scary relative to past recessions, and we're not even in a recession yet. As we'll see as we go through the economic slides in a moment, that as I've talked about in the past 6 or 8 months, it sure looks like the percentage probabilities of recession have been going up. And so we're really going to be looking at some pretty substantial debt problems. And I think the way that the budget debt ceiling discussions, if we can call them that, went down shows that even the politicians have to start admitting that these issues have to be getting addressed, and not 10 years from now. It has to be addressed in the next few years. Let's put it into a broader, longer-term perspective. This is the U.S. budget deficit going back to 1855. And you can see there actually were periods, extended periods, where there was no budget deficit. And then bad things would happen. And those bad things in the first huge deficits were war, Civil War, and World War I. And then came World War II. So 3 really bad deficit periods thanks to enormous wars. And now we're sort of in a war, a proxy war perhaps, in Ukraine versus Russia. But we now have, again, a very extended period now of virtually no balanced budget going back really almost in my lifetime. And I'll be 64 years old this year. So we need to address these problems. But here's the problem, that the fiscal responses to recessions have really gotten out of control. We see that the 01.com bust, we had a gigantic growth in so-called additional deficit. That's basically increased deficit spending as a response to attempt to stimulate the economy. We see 2007 was about the same in the global financial crisis, and the pandemic, broke all records. And so the response that we've been getting from the federal government to economic problems has been zero interest rates. That worked for a while, and then came the huge budget deficits financed by quantitative easing. I'm not going to talk a lot about quantitative easing today, but here's the real kicker of this section of the presentation, and that is that how much interest is being paid on the Treasury debt. The bottom, the green line, is a percentage of GDP, and the top blue line is just dollars. And so it was fine to run deficits, I guess, when you had zero interest rates, at least from a sort of pay-as-you-go point of view. When interest rates are non-existent, you can borrow as much as you want. You don't have the big interest expense. But now we have both the budget deficit increasing, like I showed on page 1, and of course, everybody knows the Fed's been raising interest rates for a while now. They've raised interest rates about 525 basis points on the Fed funds rate, and many Treasury interest rates are up 400 plus basis points from their trough back in 2020. So this blue line is really headed higher, and now that we're seeing that happen, we're getting a lot of rancor in the debt ceiling talks and the budget talks, because nobody knows what to do. That with interest expense going up this much, it's going to swallow all of the tax receipts in the next few years if we stay on this track. And so everyone knows that we have this required spending, entitlement spending, defense spending, and when they try to balance the budget, there's not much of the budget left. It's something like 15% of the budget is what you're down to in terms of being able to address these problems. So we're either going to have to raise taxes, or we're going to have to restructure the entitlement programs, which is the third rail of politics that nobody wants to talk about. But I do notice, if you look really carefully into the crevices of our political system, people are starting to realize that there's dust in there, and they're starting to realize that we have to start talking about this. And I do think that's going to become a political issue as part of the 2024 presidential campaign. So not only is the government, I got to line the slide up again. I don't know why this is happening. It won't line up. There we go. Okay. Not only is the government spending money, of course, but for a while, the government spending money went into people's pockets. And so personal finances were in pretty good shape. I mean, thanks to the government money spray, but people were not using revolving credit very much. They were flush with money from the government. But now that we've had more inflation for food and energy in particular over the past 2.5 years or so, we are now seeing credit card usage go way up. So we now have credit card usage. It says net monthly change on here. I'm not sure that's really the number. I think this might be year-over-year change, because I did see a statistic last week that the year-over-year use of credit cards is up about 17, 18%, and that's what this shows. You can see this is one of the largest growth spurts that's been sustained at this sort of a percentage level on this display, which goes back 23 years. So we have a lot of problems with debt and its management. Let's talk about the probability of recession now, and I'll go through these fairly quickly. The leading economic indicators, the LEI, looks absolutely full on recessionary. And not only is the 12-month number negative 8.04, but the 6-month number annualized is 8.70. So it's even more negative than the year-over-year number. What that means is the momentum of leading indicators has not improved. In fact, it's dropping at the same momentum, or even a little greater momentum over the past 6 months than it did over the prior 6 months. And those red shaded areas, of course, are recessions again. And it's pretty clear that we have the look of soon to be at the front end of a recession. This chart is one of my favorite indicators. It's consumer expectations of the future, like 1 year forward, minus the current situation. And you'll notice that the red shaded areas of the line graph, those represent periods where you're seeing the expectations of the future getting really, really bad, where the consumer expectations of their assessment of the current situation is still holding up reasonably well. You'll notice that when the red shaded area below the zero line starts to contract, that's when you have to really worry about recession. That started to happen a couple of quarters ago, but it is not happening now. So this suggests that a recession is not imminent, but certainly the conditions for recession are ripe. In other words, if people believe that their current situation is starting to deteriorate, that red shaded area will shrink and will probably introduce us into a vertical red, light shaded red bar situation. So just keep, okay. Here's the yield curve, 2s, 10s. And what we've done here, and I've used this exhibit in my last webcast, what we do is we take that blue shaded area, that is the 25th to 75th percentile of the data going into recessions. So we have the black vertical line that's at the zero level. That's historically, we know, because it's history, we know that that was the first announcement of the recessionary period. So the lines to the left of the zero that are that shaded area, that's how the 2s, 10s yield curve proceeded, sort of on average, is the black line, and median is the yellow line. What does it look like going into recessions is the point here. And the red line is where we are now and somewhat arbitrarily placed. But it shows that using this indicator, and our macro team thought that this was probably the best way to place it, even though it's somewhat arbitrary. I would suggest you might want to place this a little bit further to the right, but it looks about right to me where they have it. And so what you really need for the recession is, you'll notice that the yellow line, the median, and the black line, the average, they start to de-invert prior to the recession. You'll notice that the black line de-inverts about 8 weeks before the recession. The yellow line looks like it's about 12 or 13 weeks before recession. And maybe we started to de-invert on that red line, but not by much. So we had some de-inversion going on. We'll see that in a few slides. But right now, we would expect the short rates to start falling would be the real indicator that a recession might be at hand. The short rates are the 2-year Treasury yield is off of its highs, but it has been rising more recently, and the yield curve has been de-inverting. So this puts us close to recession. And all the next few charts are the same type of analysis for different indicators. So there'll be a blue shaded area, and there'll be the red and the yellow lines, and those will be the median and the average, or the average and the median respectively. So here's leading indicators leading up to recession. And here we have that same sort of a look. In fact, we have to place the current situation. In this case, it's a black line, not the red line of the previous slide. I apologize for that. But it looks like, based on leading indicators, as we saw from that chart a few slides ago, it sure looks full on recessionary. It's kind of like right now on recession watch using the leading economic indicators. Here's ISM new orders. That, like leading indicators, looks all very recessionary already. It certainly looks like the manufacturing economy is in recession in the United States on virtually every indicator you look at. Here's another one. This is ISM PMI. And that, again, looks like we're already in a recession. And the red line here is the average. And we're tracking very, very close to the average of the 25th to 75th percentiles historically leading into recession. Here is loan officer lending survey data. And we've got it, that's the red line. And that is plotted with GDP, so lagged by 1 year. So basically what we should show here is a high correlation between loan standard surveys tightening, which is that red line going higher, and leading into a recession with high correlation and great regularity. And so what this suggests is that blue line, which is GDP, is about to go up. And this is charted inversely. So it's inverted. So as you move higher, in other words, when the blue line goes above zero, that's really going below zero in terms of GDP. And so the red line of loan survey is suggestive that the economy will be in recession using this correlation within a year from now. And it looks like this blue line is certainly going to be headed higher on the correlation. This is the unemployment rate, which we like looking at, and we plot it versus the 12-month moving average. And one thing that we notice is in the last two recessions, right before those recessions came, the black line went above its 12-month moving average, which is the red line. That has happened now, but not in a terribly convincing way. It's higher by 4 basis points than the moving average. And sometimes this data gets revised, so I don't think we can call this a crossover in a really definitive way. But if it does put us on watch. The next employment report will be quite important. If unemployment rate rises in any meaningful way, it would probably be a recession signal. Now, there's false signals on this. So a chart that we like to use is we use the 36-month moving average, the unemployment rate versus its 3-year moving average. We haven't plotted that out, but your eye can tell you we're clearly not close to crossing above the 36-month moving average because we're still so close to the low over that 36-month time period. But this is something to watch for, and right now it's close to flashing a recessionary signal for real. Here's something interesting. This is ISM supplier delivery delays, and we all know that one of the causes of the inflation of the past couple of years was the tremendous supply chain problems. But you can see that using this ISM data, they're completely relieved. The supply delivery delays are the lowest that they've been in something like 14 years, and really at one of the lowest levels in 30 years. And I saw a chart today that we didn't include that has the same sort of a thing for the global economy. And it appears that the delivery delays in the global economy are now at the lowest level ever. So this is obviously suggestive. Why don't you have delays? Well, it's because you don't have the demand, or at least supply is now greater than demand. And so that's indicative of a weak economy as well. Next slide. This is interesting. This is financial situation deteriorating. This is sort of a survey asking people, and this is the whole population, I think, the adult population in the United States, are you better off or are you worse off than where you were 12 months ago? And the squares that is you're better off. So you'll notice that in 2017, 18, and 19, it was at a reasonably high level. People felt that they were better off, about a third of the people, than they were 12 months prior. And the people that thought they were worse off in 2018 was only 13%. But look at it now. Look how badly this has deteriorated over the past few observations. We're up to 35%. So say they're worse off now. So a complete flip from 2018 type of time frame. People felt they were better off. Now they feel that they're worse off in the same type of portion. And then we say, are you better off? Well, it's down to 19%. So these are the worst readings in basically 9 years that we're showing this data on here. So more angst, certainly, in the way people are perceiving the economy, which leads to obviously more subdued animal spirits when it comes to consumer spending. This is interesting. I talked about this 2.5 years ago when we were in the lockdown. I predicted we would start to see a deterioration in sort of mid upper level type of middle management jobs. So not super high paying jobs, but clearly not the lowest paying jobs. And indeed, that has finally begun to materialize. We see that the number of households receiving unemployment benefits through direct deposit, so it's a subset, but it's an interesting way of looking at it because it's pretty hard data. We see that the greater than $125,000 cohort is now actually losing jobs in essence faster than even the 50 to 125 cohort or the less than $50,000 cohort. And it's a pretty big percentage. That light gray line is up by about 50% over year. So this part of the economy is getting hollowed out. And I suspect that that's going to continue, not just because of firing decisions, but also because of technological changes, perhaps being further accelerated with AI. Here we have after-tax wages and salaries growth by income group, so it's the same thing, and this is from Bank of America, and we see the same outcome. We actually see that the higher cohort, the greater than 125K, is actually seeing the negative wage growth. The other cohorts are still positive, but they are declining as well. So we're starting to see higher income people starting to feel the pain of the situation, and this isn't going to help if there's wage declines with the credit card spending and with the economic growth. Here's the banks tightening lending standards again, but we're not correlating it to GDP. We're comparing it to loan growth. So we can see, and there's a 4-quarter lead, a 1-year lead here as well, as we had on the GDP chart. And so one should expect the blue line, which is C&I loan growth, to deteriorate, because we already see the lending standards survey has clearly shown much tighter lending standards over the past couple of years, and that translates with about a 1-year lag. And your eye can see there's a very high correlation here that we're going to see loan growth contracting. That's already sort of a problem. And of course, about 3 months ago, when we did our webcast for Total Return, we started to have bank failures at SVB and a couple other sort of regional banks. And one of the reasons that we're having problems here is because loan growth is contracting, and also the interest rate paid on short-term loans for small business has, thanks to the Fed's actions, clearly exploded higher. In fact, it's more than doubled since the depths of the pandemic. So we're seeing that the interest rate is now the highest that it's been in a decade, and it's pretty high at 8.5%. It's pretty hard to pay back and to pay the interest on an 8.5% loan when you're in an economy that's growing in nominal terms, less than that amount. So that's sort of the issue that's facing our economic prospects, which is another reason why I think recession is a very high probability come the end of this year, or certainly by the first part of next year. Real estate is very much in the news, struggling, and it's pretty interesting. We've got various sectors of the stock indices here. We've got the S&P 500. That's the black one that looks like it's doing pretty well. Of course, everybody sort of knows that there's 7 stocks in the S&P 500 that are responsible for basically all the return this year. If you look at the S&P 493, it depends what day you look at it, but broadly speaking, it's unchanged year to date. This S&P 493. It's the S&P 7, the AEI stocks and others that struggled last year that have really carried the S&P 500. We see the Bloomberg Office Property Index down there in orange is collapsed and it's at a new low. We see the bank stock index, the KBW, that's the regionals. We see obviously that is collapsed. And then we see regional bank stock index on there. And all those are in really weak kind of trending situations. So that's going on. And then we have the bank failures. And this is interesting because as percentage of GDP, it's only a couple of banks, but they're pretty large that have failed. And so we see that the only times you get percentage of GDP above 2% in terms of bank failures was the Great Depression and then the S&L crisis in the late 80s, early 90s, and then the global financial crisis. And we're pretty close to the level as a percentage of GDP as those past two experiences that led to financial distress and, of course, significant recessions. So this is what we're dealing with economically, and so it's hard for me to figure out where the accelerant is supposed to come from for those people that want to project higher economic growth. Here's the issue in the regional banks people are talking about is total bank deposits and the assets in money market funds. The bank deposits are down by about $1 trillion, and we see that the money markets are up by a couple $1 trillion over the past year or so. And this is the problem that these banks are having, is that they have to pay so much. Their portfolios aren't throwing off very much money, and they can't really pay their depositors what would be attractive. And so people are going to money market funds to avoid the risk, particularly government money market funds, to avoid the risk of potential bank failures that might or might not be guaranteed, although they did guarantee SVB, which is curious, for all of their deposits. But if this continues, and it's good news that the red line has decelerated going to the downside, but if the Fed keeps raising interest rates, which I do not expect, but if the Fed does raise interest rates further, this trend could reaccelerate, and that could be further problems in the banking system. And of course, this is the thing that nobody wanted to talk about prior to these banks failing, is there are massive unrealized losses on investment portfolios at U.S. banks. So we see how the higher interest rates from the pandemic, with the Fed raising rates and the bond market anticipating in advance that the Fed needed to raise interest rates, we had a 50% drawdown, peak to trough, on the 30-year U.S. Treasury bond. And of course, these institutions had to own longer-term securities. You can't hedge out the interest rate risk. There's this urban legend that I keep hearing in financial media that these banks were badly managed because they should have hedged out their interest rate risk. It doesn't work that way. You can't hedge out the interest rate risk without going back to a zero interest rate. There's no free money. If you want a yield above zero, you want to buy the long bond at 2%. Well, if you hedge out that the duration risk, you're going to be right back at a zero yield. So it doesn't work that way. So the problem is that there's still, although it's gotten better with interest rates no longer rising, really since last October, point to point, we still see that the losses are very severe, and any kind of a run on deposits that could be caused by the Fed further raising interest rates, which is a good reason why they shouldn't do it, it could lead to further dust-ups in the regional banking system. Now let's talk about inflation. One thing that's interesting underneath inflation is the money supply. I mean, when you gun the money supply, that's the definition of inflation, really. And it might show up in financial assets, and which it certainly did for a while. And now then it showed up in food and energy and other commodities. But it's interesting that the money supply is now the most negative that it's been since the Depression, which is not really make one's comp somebody down, that we're in the same position with M2 growth as we had in the Depression. But one good thing about it is monetary contraction does take pressure off of inflation. I mean, here's the proof of that. This is M2 versus CPI. And what we see here is that when the M2 goes down, particularly a lot, we see inflation relaxes, and then vice versa. So this suggests that the CPI on here, that the CPI should be coming down. It's at 4.9 right now. It's been coming down very fast, almost exactly the speed at which it went up. And now we see this collapse in money supply. So the inflation rate is still elevated, I guess, particularly if you look at it over the last 2-year period, using a 2-year inflation stack. But the M2 problem is no longer stoking inflation. using this correlation. So here's the CPI, and the headline is 4.9 and the core is 5.5. So for the first time in a couple of years, the headline is below the core, but the core is up at 5.5, and that's kind of sticky. And the Fed has repeated relentlessly that they're getting this inflation rate. They're going to get it back down to their target, which they say is 2%. I think if they got to 3, they'd be pretty satisfied with that. There's a lot of talk that really maybe the inflation target isn't really 2%. I mean, a lot of people thought the 2% number was just created out of thin air. In fact, some Fed chairman even said that in decades past. But what we see now is the inflation rate is certainly coming down, and I would expect the CPI will fall further, particularly if the recession shows up. I mean, that almost always would lead to some decline in the CPI, but we'd have to see exactly what shape that recession takes, because sometimes you can have a stagflationary situation with the money supply doing what it is. I don't really think that's the base case. This is contribution to the headline CPI inflation. And so you see services is a huge slug of, that's the blue part of the stacked bars, is a huge slug of the source of inflation. In fact, the only thing else is food. Services and food is just about the whole thing. Energy is now contributing deflation to the economy, and oil is really kind of stuck at around 70 plus or minus for WTI, in spite of price cuts being talked about from some of the oil producing nations. But it's really services, which tends to be pretty sticky, and then food, which perhaps will come down, might depend on the weather this summer. Here's the contribution to core inflation. And here we just break it into 3 things. Shelter is a big piece here. Shelter represents more than half of the inflation right now. Core services ex shelter, which is Jay Powell's newfound preferred inflation measure. So you're talking about a very small fraction of the economy. I think core services ex shelter is less than 25% of the total components of the CPI. But shelter is a big piece. And then we see the core goods ex shelter. That's still pretty sticky. That's what Jay Powell's looking at. And then we see core goods, which is contributing almost nothing to inflation. So right now it's that super core that Jay Powell has been following for the past 8 months or so. And then there's shelter. And shelter has been stickier than most people expected. Most people thought with mortgage rates going up so much that it would be a real disinflationary to housing. But what people in fact factor in is the change in mortgage rates, which I'm going to get to. This is at super core inflation that I like to look at. We've got it on here, less housing, and same numbers basically for both of these lines. Here's the PCE. Fed likes this one too. I think this one's one of the most manipulated, easy to manipulate inflation series. But here we see the same thing as we saw in the CPI, and that is that the core is now 4.7. It's higher than the headline, which is 4.4. So headline PCE and headline CPI are just about the same, both in the mid-4s. And we might be ending the period of rapid deceleration in the PCE and the CPI, because we now have the easy comparisons. The numbers that are rolling off have helped, because there were big numbers that rolled off. They've helped. They haven't been replaced with the same magnitude this year as they were in the same months last year. That's about to come to an end, it appears. So we expect to see inflation come down, but not at the pace that the Fed wants to see. So it'll be a real interesting tug of war between the recessionary indicators and the Fed wanting to get closer to their target, and those two things are very much at odds. So it's quite a tightrope they need to walk. Now, let's look at some inflation numbers that I think are a little bit more representative of what's really happening. First is what used to be called wholesale prices, the producer price index. Year over year, it's down to 2.3. I mean, my gosh, the final demand piece of it's down all the way down to what the Fed wants, near the 2% number. And it leads the CPI. So there's a reason to believe the CPI will come down. And then we see ex food and energy, it's at 3.2. So we had the PPI back there a year ago up in the double digits for the final demand and nearly 10% for the ex food and energy. And that's come all the way down really to pre-pandemic types of levels, back to 2018 types of levels when the Fed was seemingly completely relaxed about the inflation conditions. So these are sort of reasons why maybe the bond yields have stopped going up. I mean, bond yields peaked last October into November, and they're down quite a bit, although trading in a range, and 10-year Treasury can't seem to get above 4% and stay there. Can't even get up to 3.90 these days. And we see that the short rates have gone up. We'll see this in a minute. Let's see, my screen has changed. I need some help. Okay, there we go. I hit the wrong button. Okay, so that's producer price index. So here's my favorite inflation measures because they're the most unadulterated. They're just prices, and they don't have all these hedonics and replacements. It's just export and import prices. Now, the mix can shift. So it's going to be, mix shifts can have some effect on it. But look at where these levels are. U.S. import prices are now negative 4.8% year over year, and export prices are negative 5.9% year over year. These are some of the lowest readings that we've seen in the past decade and a half. So these prices have certainly come down. In fact, they're in deflationary mode right now. So I'm wondering why people are so bearish on bonds, or had been so bearish on bonds, because many things that one should worry about with bonds, A, inflation, that's been relaxing, and B, really low interest rates. Well, they might be low for people like me that remember double-digit interest rates, but clearly interest rates are a lot higher now than they were 2.5 years ago. And so bonds are much more attractive, and their inflationary nemesis has been in retreat. So that's why I think bonds are superior asset class right now. I've been advocating sort of instead of a 60-40 type of portfolio mix, I've been advocating more like 30-60-10. So 30 stocks, 60 bonds, and 10 real assets. And that real asset that I've liked is gold, which has gone up this year, but has a very hard time staying above 2,000. Now, here's wage inflation, different measures. This is getting a little better, but wage inflation has been somewhat sticky. Not so much for the greater than $125,000 earning crowd, which we saw earlier, but we see the blue line, average hourly earnings, that's come down a fair amount. That's come down from 7% to about 5%. The Atlanta Fed wage growth tracker, that's the black line, that's been stubborn, still running about 6%. And the Bureau of Labor Statistics employment cost index is a sort of a quarterly number, so we don't have as many observations, but it looks a lot like the wage growth tracker. It's just a percent and a half or so less. So these need to come down, and this is why the Fed needs to weaken the economy, because it's clear that the wage component of things has been slower to come down than commodity prices. Here are commodity prices, Bloomberg Commodity Index, and we talked about this for the past year, how it just can't get above its 200-day moving average. And I like gold just because it's a kind of a real money sort of a thing for part of your financial portfolio. But I really don't like commodities. I haven't liked them for a year just because the economy is weakening, and we're probably headed to a recession sooner rather than later, and commodity prices probably won't go up during a recession. And so I've not liking commodities, and it's been a good thing to not like for the past really 2 years now, or at least a year and 3/4. So we'll be following that. It certainly has not looking inflationary, the commodity complex. Here's gold, long term, and look at that triple top. So it gets above 2,000 and stays there for a very short period of time. And now we're back down to about 1965 or so, I think, as of today. And so you need, it seems like gold's been consolidating. It's certainly done well over the past year, gone from 1,600 up to nearly 2,000 now. But I'm less bullish on gold simply because of this triple top concept, but I still own it. Okay, so this is an interesting scatter of the core CPI on the y-axis and the unemployment rate on the x-axis. And we've got the dates when the Fed started cutting rates. Those are all those dates on there. Those are years when the Fed stopped raising rates and started cutting them. And here we are today. So we're at very low unemployment. So certainly the unemployment piece of it is what the Fed's probably focusing on. And we have the CPI that's very much in the context of some of these dots. So it's really the unemployment rate that is keeping the Fed on the snugger side. Oops. Speaking of that, here's what interest rates have done, and this goes back there's two lines on here. There's the orange, which is December of 21, sorry. So that goes back a year and a half now, just about. And we've got yesterday. And so the blue line obviously is inverted, and we see the orange line was quite steep, 100 from 1 month out to 30 or 188 basis points, but now we're inverted by about 130. So this is what the Fed has done. I really think, and I talked about this at the time, I really think the Fed screwed up by waiting about a year too long to raise interest rates and not raising them fast enough. I think that's why inflation got as high as it did, why it's been somewhat sticky in parts of the inflation picture. I think they should have raised, when they raised rates the first time, they probably should have already raised rates by 200 basis points by the time they actually got started. And so they really sort of unleashed this conundrum that they put themselves in. And I also think long rates went up in anticipation of the Fed kind of goading the Fed into raising interest rates. And I think if they had raised interest rates sooner and faster, we wouldn't have had yields go up as much. We might not have had these failures in the banking system. So it's unfortunate. This is the interest rates going back to early 2022. We got the 2-year Treasury yield, which even at the start date was quite a bit above zero by then. It was getting way ahead of the Fed. The Fed had to follow the 2-year Treasury higher. Then we see it peaked out the 2-year in the upper left at 507. And then we had the big collapse because that was the banking crisis with SVB and a couple other banks failing. And that made people think the Fed might be need to ease interest rates. But that attitude has relaxed in the past couple of months. So you'll notice that the 2-year Treasury today is exactly where it was back in about September, October, November of last year. So we've had no change in interest rates now for almost a year on the 2-year. Look at the panel to the right of it. There's the 5-year, same picture. It's not as volatile, but we're basically at the same interest rate as we were around October, November of last year. 10-year Treasury, same thing. It's coiling and consolidating. The 30-year Treasury looks a lot like the 10-year. So the yields haven't really moved very much over that time period. There have been yields in various parts of the market that people are concerned about that have moved. And we'll get to that in a minute. Just to take a visit with our friend, the copper gold ratio, it's really disconnected here. The red line is the 10-year Treasury yield. It's up at 369 as of yesterday. And we see the blue line, copper gold ratio, suggests that the 10-year Treasury yield might have fair value down at around 2% or so. So there's certainly room for the 10-year Treasury to rally, particularly based on copper gold and on the idea that inflation is declining. So when Andrew goes through some of the facts of the portfolio, people will notice that we are at the longest duration in the total return bond fund that we've been at in the history of DoubleLine. We've been at that level pretty much building up to that level into a few months ago, and it's been that those duration moves have helped performance. And, I don't know if people are paying attention during Ron's thing of the performance, but the 3-year numbers on the total return fund are really, really strong. Here's yields in the fixed income sector. In the fixed income market. These are so-called yields to worst, so it's to the worst call date, but it assumes no defaults on all these credit positions. And of course, the market is rather strongly suggesting that there's going to be defaults. Look at the yield to worst on CCC leverage loans, 19.4. Well, obviously, CCC leverage loans are in some pretty big trouble because they float every 90 days or so, and the Fed's raised rates 525 basis points. So these companies that are marginal credits at CCC, that's being kind to say that they're marginal. Everyone obviously expects defaults there. We can also see investment grade or high yield bonds, the CCC, that's 13.2. Obviously, the market is getting ready for defaults. I pointed out in my last webcast that when the Lending Standards Survey, the SLOOS survey, shows significant tightening of credit conditions, you start to get defaults in high yield within about a year. And they've been tightening for a year. And obviously that tightening has accelerated with the SVB situation, further leading to caution from lending officers. So we can get to the aggregate on the left, 4.7. So we have a yield advantage net of fees in the iShare class of about 60 basis points or so. And then we see that treasuries are at 4.1. That's a lot of that coming out of the short end of the curve. And then we see investment grade credit at 5.4. So lots of yield, unlike 3 years ago when we were living in the fixed income dungeon, where their spreads were super tight and the treasury yields were basically non-existent, particularly on the short end. That's gone now. There's plenty of opportunities in the bond market. You can play it really safe and buy the DoubleLine Total Return Bond Fund, where the credit quality is quite a bit higher than most of these sectors here. And Andrew will go through some of those things. Or you can take risk and buy things that are riskier funds, like closed-end funds, things like that, where yields are available in the high single digit to low double digits. So these bond funds, if you think about the risk of them and the reward of them, back a year and a half ago, stocks were cheap to bonds. As overvalued as stocks were, they were cheap to treasury bonds and bonds broadly. But thanks to this increase in yields, bonds are absolutely cheap to stocks at the present moment, and it would be a much more relaxing way of earning returns than white knuckling it in a stock market in an economy that's perhaps going into recession. Here's credit performance year to date. So we've sliced and diced the fixed income sectors, and you'll notice that CMBS BBBs really stand out because that's a sector that everybody knows, particularly in the office space in major downtown areas, have a lot of vacancies and a lot of problems. But that's not lost on the market. That's why that's negative 3.8 year to date. So there's certainly opportunities galore in CMBS. And if you're interested in those, I would recommend you listen to the DCMB ETF call with Morris Chen, who's done a fantastic job in managing CMBS for us, particularly over these past 3 years, where all this trouble's thrown at us. We can see the best performing sector is CCC high yield, up 6.8%. So rebounding from the carnage of last year. And we see that high yield broadly is up 4.5. That's pretty good. And CLOs are doing quite well. We talked about this in the Just Markets webcast, that some of these securitized products were lagging the corporate bond market, and they're certainly catching up. And we think that there's a lot of room for that still to come, even though it's happened partially so far this year. Here's spreads, just to check in on investment grade on the left and high yield on the right. You'll notice the scales are very different, but the charts look identical. They look like the same chart. It's just that the scales are different. So we saw the blowout in spreads during the lockdown, and then they came all the way back down to where they were pre-pandemic. And then we see they widened out part of 2022, and now they've kind of stabilized. So these spreads have really lost their volatility over the past couple of quarters, just as the treasury market has settled into more of a range. So we don't have this trending market that we had to suffer through last year. But watch out, there's something out there that this is why these bank loans at the lower tiers are trading at such ridiculous yields if there's no defaults. Well, there's going to be defaults, and not only will there be defaults, but this is the recovery rate is calculated 30-day post-default prices. So in other words, how much are you recovering? So if a bank loan defaults, are you getting back the 70 cents that most models used to predict would be a base case? Well, no, you haven't had a 70-cent type of recovery rate in the past 8 years. Well, I guess you did back there in 2017, but now we're running at 50-cent recovery rate, and we're not even in a recession. So if a recession comes, these recovery rates could be pretty scary on some of these, and these are floating rate too, so, which means the pressure is on the CFO of a bank loan borrowing company. The pressure's on right now. Here's something good about the high yield bond market, which Robert Cohen, who runs our credit group, brought to my attention. I wanted to bring it forth. Look at the percentage of new issue high yield that's secured versus unsecured. You'll notice that the unsecured stuff back in '07 and '08 was almost everything. And gradualistically, over the past 5-6 years, we've seen the secured percentage of new issuance go up. And that's obviously being secured is a lot better than being unsecured. So the high yield bond market might look a little tight on a yield spread going into recession, but one thing you have to acknowledge is that it is lower risk, certainly the issuance of this year, and it was getting lower risk because more of it was being secured. So that's a good thing for the high yield market. And look at the share of high yield by seniority. Look at where unsecured was and where secured is now. So secured was 6% of the entire high yield index, and now it's 29%. Obviously, that's going to continue to grow if the trend of this year and last year moves along the way into the future. We'll be getting more and more percentage of the high yield market that is secured, and that's a good thing, obviously, and would support the idea that maybe spreads don't have to blow out even if there's a recession as much as they did on average historically, because the market mix is changing. And here's where spreads are, and this is plotted against leading economic indicators. So high yield spreads on the y-axis, leading economic indicators year-over-year change on the x-axis, and then we've done a fit. And you'll see that the current spreads on high yield relative to leading indicators, they look very tight. So while the credit quality of the high yield bond market is definitely better, the spreads seem a little bit on the snug side based upon this fit. But one more thing on the credit quality, bond recovery rates definitely deteriorate much worse for unsecured bonds during recessions than they do for senior secured bonds, which are making up an increasing proportion of the high yield index. You know, it's the light blue line. It really kind of never goes below about 40 or 50, whereas the dark blue line, which is the recovery rate on unsecured bonds, is like half that or worse during recessions. So the high yield bond market is vulnerable to recession. Spreads are a little bit tight, but it is true that the credit quality of the high yield bond market is better than it's been really at any time in the existence of the high yield bond market which goes back to the 80s. Let's just take a real quick look at EM, and then I'll be handing it over to Andrew fairly shortly. But here are spreads on EM. But they look very similar to the spreads on high yield and on investment grade. They've tightened less than we've seen tightening in the high yield market, investment grade market over the past couple of years. But they've stopped really, they've lost a lot of their volatility as well. It seems like the emerging market category can't really get to 600 basis points sustainably versus treasuries. In fact, this year, we haven't really been able to sustain even 500 basis points. And we've been around this 463 number for a lot of the past several months, going back to October. So here's MB spreads, emerging market spreads plotted against the dollar. And it's very obvious that they're correlated. So when the dollar goes up, emerging market spreads tend to widen. When the dollar goes down, they tend to tighten. That has not happened now. So maybe there's a little bit of a divergence, a little bit of an alligator jaws situation in the last couple of months. So maybe emerging markets are about to perform a little bit better. And the dollar index will probably start to go down, particularly in the next recession, and particularly if we don't deal with our deficit problems, which we just kicked the can a couple of years down the road. So I think it's fair to say that we're not going to be dealing with our deficit problems in the next year, but we have to do it after that, and that's going to be a very interesting process. Here's the Dixie Index going back to 1998. And, it rallied from the global financial crisis into late 2022 and then started weakening. And dollar has stopped weakening for the near term. In fact, it's rallied a little bit up to about 104, but I certainly expect that we're going to see that line ultimately, that horizontal line, ultimately, we'll meet that line, and I believe we're going to take it out to the downside. So the dollar is likely to be vulnerable, and that's going to be good for non-dollar investments and ultimately probably lead to a tailwind for emerging market debt. Here's JP Morgan Emerging Market Currency Index, which looks a lot like the commodity chart, although this one now has broken below its 200-day moving average where it had been above it. So it's really not sending much of a signal here, but I guess I would suggest that the emerging market currency index probably has bottomed. So it's going sideways, not a lot of action right now, just like spreads have been going sideways, not a lot of action. But I do expect this index has bottomed. That'll be good for EM. Here's mortgages, and then I'm going to turn it over to Andrew, and I'll come back to summarize some of the Q&A. But look at mortgage rates. They were down there at 2.75% for a long time. We haven't taken this back to, past 2021, but they were down at those levels, 3% or lower for a very long time. And then we had interest rates go up, and they went up to 7%, and they're still above 7% for the 30-year Freddie Mac or Fannie Mae rate. And people think, well, wow, I mean, you would think that would be really, really bad for the housing market. But one thing that people don't focus on enough is how high the commitment rate is today versus the outstanding mortgage debt. So if you're one of these people that took out a 2.75% mortgage, you might want to move, but to get rid of your mortgage and to take out a new one up at 7% or so, more than double what your rate was, that's not a very attractive proposition. So there's just nothing for sale versus history in the mortgage industry in the United States. And we can see that. Here's the MBA U.S. mortgage purchase rate, which is really low. I mean, it's the level that we were in the aftershock of the global financial crisis. We're actually lower today than we were at any point in the global financial crisis. We're off the all-time low, which looks like a year-end anomaly to me here, but we're basically on the lows going back through the entire data set, even though this only goes back to 2001. It's about the lowest it's ever been. So we're seeing the strange thing that housing prices haven't dropped very much. There's some metropolitan areas are down a few percent, but some of the more recent data actually was showing stability year over year in prices. So there's no stress really there's no default stress at all in the mortgage market. For agency mortgages, you would like defaults. You're not going to get any, but you'd like defaults because a lot of these securities are trading at a discount, and if it defaults, you're guaranteed at par. But in the non-agency mortgage market, there's just no default pressure really to speak of, just tiny deteriorations, if any. And now here's thanks to the rise in interest rates and the fact that on the two charts ago, I showed how much higher than the coupon is on the mortgage market are new issue rates, that prices of existing securities are down. And so this negative convexity problem in mortgages is non-existent. There is no negative convexity to speak of. In fact, it got positive about the only time in most people's careers last year, but it's still hovering at about zero. So we don't have that convexity problem. So you would think that mortgages should be pretty rich versus their typical pricing, but nothing could be further from the case. We see that mortgage rates went up, spreads went up a lot. They went from 120 in January of this year, and from about 110 in August of last year, and they just skyrocketed up to a high of 193 basis points. That's because everyone was so worried about the disposition of this SVB stuff and other failed banks. But typically, as is always the case, the market anticipates, and these spreads blew out. And so when they finally started to liquidate or accelerate the liquidations of some of these mortgage pools, that was the peak in mortgage spreads. So mortgage spreads are still really attractive, and particularly relative to their lack of negative convexity, this could be one of the most attractive points to own the agency mortgage market. And I think I saw an article on Bloomberg today with some competitor of ours coming to the same conclusion, that agency mortgages are the cheapest part on a risk-adjusted basis, certainly in the entire fixed income market. And here's on an option-adjusted spread basis. So we're taking into account the callability, which doesn't really exist right now, but certainly has been a factor for much of the past 25 years. And so we see that the OAS was negative back there in 2021 when we took our mortgage holdings to the smallest share of DBLTX that we had at any time in the history of DoubleLine. And then when the spreads widened out, we've been reinvesting in mortgages, but we see the OAS is very high. So the mortgage market is just systematically cheap. And now finally, we take a look at interest rate volatility. So you'll notice that mortgage spreads, which is the red line, plotted against the blue line, which is interest rate implied volatility from the market, they're basically the same line. So one of the reasons that mortgage spreads went up is the implied volatility went up, but also it went up in anticipation of these dispositions from the failed banks. So we see that the mortgage spread definitely tracks with volatility. So what's the prognostication for volatility? Well, one thing that's interesting is volatility tends to be quite high before the Fed pauses. Just look at the left panel here. I'm not going to speak to the right one. The left panel, these are trading days relative to the last hike using historical interest rate cycles. You'll notice that the volatility goes down pretty remarkably and then stays very stable for a number of weeks as the Fed pauses interest rates or stops hiking, does its last hike. So that rather strongly suggests that we should expect a decrease in volatility as the Fed is getting close to, or maybe already has done their last hike. I think they already have done their last hike. And so volatility should be coming down in the weeks ahead, which means mortgage spreads have a huge tailwind to be tightening in, making them even more attractive relative to the Treasury bond market. With that, it's my last slide, and I'm going to hand it over to Andrew to quickly go through the facts of total return. I know I'm already past an hour, so I'm going to take just a couple of questions. I feel like I read many of the questions before launching into this presentation, and I think I've answered a great many of them along the way. So thank you for those questions. Andrew, can I hand it back to you?
Yeah, thanks a lot, Jeffrey. So we're going to start off here and look at a couple of just fundamentals about the portfolio, and this is definitely very relevant. We've had a lot of clients ask us about commercial real estate, and I'll talk about the holdings in a little bit of detail later, but first let's take a look at some of the fundamentals. On the left, what we see is a chart on the CRE National Property Price Index, and this has been declining in 2023. This index is transaction-based, meaning any changes that we see in this index are a result of an actual transaction. First quarter of this year, transaction volume was brisk, and what we saw were valuations across pretty much all property types lower across the board. Second quarter, a very different story. Markets slowed down significantly. So what appears to be maybe a stabilization prices is more a reflection of transaction volume slowing down than valuation plateauing. We do expect further declines in values as transactions take place in certain areas of the CRE market on a go-forward basis. On the right, we see delinquencies, and this is across property types. I'll point out the orange line here. This is the lodging segment of the CRE market. That is showing steady improvement in terms of delinquencies, but the retail side in the light blue and then the office, which is the yellow line, they do continue to see increased delinquencies, and these are the more troubled areas of the commercial real estate market. Looking at the broader consumer market, earlier we referenced that credit card utilization is going up. Well, so are credit card delinquencies. So the purple line here, we are seeing a pretty rapid rise in delinquencies in credit cards. But what we are noticing is that consumers, they're triaging their debt burdens, meaning they're prioritizing liabilities depending on their utilization. So the more utilization they can get out of that liability, the more likely they are to service it. And having said that, mortgage delinquencies, they remain near all-time lows. And it does appear that finally, federally funded student loans will resume payment on August 29th. So we may see delinquencies pick up there. I do expect to see delinquencies pick up in the student loan market as payments do resume. Looking at the portfolio, the first thing we'll take a look at is the commercial real estate subsegment of the portfolio. Let's focus on the top table first. These are CMBS investments in the portfolio, and they account for 7.4% of the overall portfolio. They are diversified across 4 security types. All of these security types are secured, meaning there are assets pledged to the investments. Jeffrey did mention the benefits of having a secured investment. These are all secured. And not only do you have all the assets, you have a pledge of all the cash flows associated with those assets as well. I do want to point you out to one column, and that's the tranche LTV column. It's on the far right. And so I know there's a lot of concern about commercial real estate here. So for example, if I look at the top row that shows conduit CMBS positions, we have a 54% tranche LTV. What that means is that the underlying asset needs to fall by more than 1 minus 54%, which is 46% in value, in order to see even a dollar principal loss. So across the entire CMBS holdings, the average tranche LTV is 49%. The bottom table, what it shows is really property types that we're secured by. And you can see that we're pretty well diversified. We do have 13% in retail and 24% in office exposure. I did mention that we are seeing delinquencies pick up there. But what I would say is that every single position that we own in total return bond fund is underwritten at the asset level. So every single asset is underwritten and stressed. So we do feel very comfortable with our positions, even if they are in the quote unquote stressed CMBS space. Looking at portfolio statistics from a price standpoint, we are matching pretty closely with that of the index. But you'll have to remember, we do own a larger portion of MBS securities versus that of the index. So in a environment where prepayments should rise, there is substantial optionality there in terms of our portfolio. Duration is also identical to that of the index, something that we're very comfortable with. And you will have to remember that we do combine structured credit, which are amortizing assets in the portfolio, to offset some of the risks associated with rising rates. And then with duration and price the same, what's not shown here is the yield to maturity. We do have a 160 basis point advantage versus that of the index. This is a graphical depiction of our duration over time. We have extended duration in the past, most notably in 2021. We did use treasuries at that point in time. Now in 2023, with mortgages being as attractive as they are, we have utilized them to achieve our duration targets, and very comfortable with that. Do see that as a very good opportunity for this portfolio. Looking at portfolio composition, we have been improving the quality of the portfolio with increased allocations to government guaranteed sectors, which account for more than 58% of the overall portfolio at this point in time. On the credit side, we do receive regular interest and principal payments as well. And we've been recycling this cash flow to migrate to the senior most portions of these credit sectors. So again, really defensive, but with the way the yield curve is shaped, able to pick up very attractive yields despite moving up in quality. The final slide for me here before I pass it back to Jeffrey to answer some of the questions that have been coming in. We're looking at the credit side of the portfolio and comparing credit enhancement to serious delinquencies. As a reminder, credit enhancement is the ability for an investment to absorb losses before any principal impairment. And you can see the one thing I always like to point out is that on the left-hand side, we do see legacy non-agency mortgage-backed securities. I want to note that the discount dollar prices are not factored in here. So in the case of legacy mortgage-backed securities, we should be adding in additional 38% to credit enhancement to the existing 14%. So again, on the credit side of the portfolio, do feel very comfortable with our positioning. So with that, Jeffrey, perhaps I'll hand it back to you here.
All right, thanks, Andrew. There's a lot of the most consistent theme through the questions today is it okay to own the long bond? Do you think should have rates peaked? And I stated last October that I thought that was the time to buy longer duration, high quality bonds like treasuries. And we started doing that in the total return fund. And as you saw from Andrew's slide, we've extended out and our treasury exposure is more on the long end, which hasn't been that great lately, but it's been a very good thing going back a couple of years. And we think that we extended duration intentionally and substantially, and it's helped us. And so I do think it's safe to own longer term bonds. And I do think that you're going to get a rally during the next recession on the long, at least initially. Things can always change depending on the response to the recession. But at least initially, I think you will get a rally of significance, and you're going to see profits being made on longer term, very high quality bonds. So yes, I do think we've seen peak of the long end in interest rates for this cycle. Then somebody says, I think maybe facetiously, on the debt ceiling, I like this question a lot. Why does the government not mention modern monetary theory, MMT, is the way to quote unquote prevent default if it's such a sound theory? Well, it's not a sound theory. We have proof. The people that were talking hypothetically about you can just print your way out of things with no consequences have already been completely run out of the room. Because when they did print the money in 2020 and 2021, we got import-export prices in the high teens. We got the CPI close to 10% year over year. So you cannot print your way out of your debt problem without bringing on an inflation problem. And so you cannot, you have to address things in a sound, organic way, not with funny money. So with that, I thank everybody for joining us. It's been an hour and 10 minutes now. So I'm going to wrap up. Thank you for your interest in DoubleLine. Thank you for your confidence in DoubleLine. I'll just remind everyone that I have my largest single investment is DBLTX, and I have well into 9 figures of my own money in the DoubleLine Total Return Bond Fund. So with that, I wish everybody a nice summertime. And we'll be back to talk about Total Return Fund in September for a back to school situation. And thank you for your support, and goodbye for now.